At the outset, I would like to thank VC Circle for inviting me to speak at the Financial Services Summit. I understand that the most relevant topics pertaining to the financial sector have been selected for discussion at this summit. I am sure that the participants would have gained enormous insights from the panel discussions and would be able to appreciate the huge potential of the financial sector. I will divide my talk into two parts. During the first part of my talk, I will provide my views on the immense potential of the financial services sector. In the latter part, I will touch upon the important role that data analytics and digitalization is playing in the financial services sector. I will also provide my perspectives on some of the challenges, especially on how boards are addressing cybersecurity risks. Despite the pandemic throwing a wrench into India's economic growth last year, it is still very apparent that India continues to be on course for a $5 trillion economy. I do strongly believe that it is an achievable target. If one observes the progress of the Indian economy, it has been remarkable. It took India 60 years post-independence to become a $1 trillion economy in 2007. It took another 7 years to become a $2 trillion economy in 2015. If not for the pandemic, India would have easily been a $3 trillion economy. India is now likely to become a $3 trillion economy before the end of financial year 2022. India's GDP grew by 20.4% in the first quarter of the current fiscal. Although the growth came from a low base of last year, the recovery has been much better and faster than anyone expected and shows that the Indian economy is truly on the right path. Further, the vaccine approvals and the subsequent process of administrating the vaccines have raised hopes of a normalization of the economy amidst the pandemic. Of course, renewed waves of infection in India do pose some serious concerns. Here I would like to mention that the government needs to be commended for its efforts as more than 1 crore vaccination shots are being administered every day. So the question is not whether India will become a $5 trillion economy, but really the question should be on how soon it can achieve this goal. There is no other economy in the world that currently has the capacity to absorb the scale of investments that India needs or has the growth potential that India offers. The progress made by the financial services sector will be critical in enabling India to achieve a higher growth rate, as this sector is the backbone of any economy. I'm extremely optimistic about the growth opportunities in the financial sector, and there are several reasons why I believe so. Firstly, India has favorable demographics. India accounts for 17% of the world's population, or 1 out of every 6 person in the world is an Indian. And 66% of this population is under the age of 35 years. If you combine India and China together, that accounts for 37% of the world's population. India's middle class is estimated to rise from 250 million individuals currently to 800 million by 2030. India is a domestic consumption-based economy. Private consumption forms 60% of the economy. India is poised to become the third largest consumer market behind US and China. Consumer spending in India is expected to grow from $1.5 trillion at present to nearly $6 trillion by 2030. Thirdly, financial penetration in India is extremely low, which implies a huge potential for growth. The mortgage to GDP ratio, for example, in India is 11%. In China, it is 26%, and in the US, the ratio is 52%. Here, I would like to mention that the structural demand for housing in India will always remain strong due to factors such as improved affordability, the government's trust on affordable housing, favorable demographics, increasing urbanization, and rising aspiration of our people. 2/3 of India's population is below 35 years of age. And unlike the West in India, people do not buy a house when they are in their 20s. The average age of a first-time home buyer in India is about 38 or 39 years. And with 2/3 of the population being below 35 years, what that really means is that 2/3 of the population is not even contemplated buying a house as yet. However, over the next 3, 5, 10, 15 years, all these younger people will get to an age where they will necessarily have to buy a house. Therefore, in my view, there will be a structural long-term demand for housing and therefore housing finance in India. Further, certain states have provided time-bound relief. For example, Maharashtra had lowered the stamp duty from 5% to 2% for properties registered before 31st December 2020 and then to 3% for properties registered between January 1st, 2021 to March 31st, 2021. Coupled with interest rates being at an all-time low and with the reduction in stamp duty, Mumbai recorded historic registration of home sale deeds. In the life insurance sector, the penetration in India stands at 3.76% of GDP. Malaysia, Thailand, China all have ratios closer to 5% of GDP. The government is aware of the opportunities in the insurance space and has increased the FDI limit from 49% to 74% this year to help insurers attract foreign capital to expand their businesses across India. Similarly, if you look at India's mutual fund penetration, it stands at 16% of GDP compared to 114% in the US and 73% in the UK, which means that with a population of 1.3 billion people, barely 2% invest in mutual funds and equities. We need to get more youngsters to become more patient long-term investors in equities and mutual funds. In this regard, we are moving in the right direction. In 2014, the combined assets under management of all mutual funds hit the rupees 10 trillion mark, and in just 3 years, in 2017, it doubled to rupees 20 trillion, and as of June 2021, the assets under management of mutual funds touched an all-time high of 33.5 trillion rupees. 57% of the industry investor base are retail investors. If you look at India's consumer credit to GDP, it stands at 18% and is one of the lowest that you will see for a large economy. In the US, this ratio is 80%. In China, it is 40%. And I repeat, in India, it is only 18%. Over the past few years, India is progressing on the World Bank's Ease of Doing Business Index. In 2019, India recorded a jump of 14 positions to be ranked 63rd. The government on its part is continuing towards further improving the ease of doing business, reducing the cost of doing business and ensuring a stable and fair regulatory framework. India will be attracting greater global capital as investors are craving for higher yield, and India has demonstrated that it can deliver attractive returns. To summarize this section, India still remains a hugely underpenetrated market, and this is where the focus of growth should be. The sheer size of our population offers a great opportunity for growth. We have to take it in our stride that there will be times when the Indian economy will grow at a faster pace, and there will also be times when the growth rate will be more moderate. Market cycles are inevitable, but as long as we continue to focus on financial sector reforms and enabling policies, I think there is no reason why India won't retain its rightful place on the global stage. Let me now come to the second part of my talk, and that is on the digital economy. Although the penetration of internet and broadband access is so far low in India, the potential to grow is immense. With the advent of mobile banking, the access to financial services is getting completely revolutionized. This trend will continue to grow further over the next decade. Mobile technology is low cost, affordable, easily available, and can help financial service providers penetrate markets and increase their customer base. This is really the future. India is rapidly digitizing. India's digital economy is expected to be $1 trillion when the total economy touches $5 trillion. That is 1/5 of the Indian economy will be digital. Further, India is the second fastest digital economy after China. Continuing digital transformation is changing the way people interact, as it enables consumers to both compare value and expand their choices. I want to give you an example of how financial transactions have become easier over a period of time. Not too long ago, we had to fill in lengthy forms to initiate investments. But now with the click of a button, we can invest in shares in the secondary market, we can subscribe to IPOs, we can buy insurance, we can buy gold, and we can do a whole lot of things which in the past we could not do. Digitization is changing the way consumers understand finance. Simple applications, better user interface, and intuitive language has made it easier for consumers to both decide where to invest as well as execute their investments in an efficient and seamless manner. Reaching out to customers with no formal savings or pensions, or who have no engagement with financial services, is a key focus of the government's inclusive growth package. Bringing a larger number of people under the financial services net in rural areas is a priority for the government. Moreover, with fewer bank branches as well as fewer insurance and mutual fund agents, the rural market offers even higher growth opportunities than urban cities. The other initiative will help reduce the percentage of the population by providing them access to a wide variety of financial products and services. It is estimated that more than 95% of our population now have Aadhaar cards. For financial services institutions, this digital transformation provides a huge opportunity to access new underpenetrated markets across the length and breadth of the country. To grab this opportunity, financial services institutions will need to invest in human resources and technology to optimize customer service and business processes. Continuous training on new technologies will be required, and products will need to be tailored to different categories of customers, including the young, the middle-aged, and the pensioners in both rural as well as urban markets. Investors are extremely optimistic about financial technology or the fintech industry. According to a McKinsey report, investors believe that many of the new age fintech companies will become important players in the Indian economy in the years to come. Banks are now joining forces with fintech players to upgrade their existing systems to enable end-to-end customer service. In fact, during the pandemic, when people were forced to stay home, fintech companies innovated their offerings to become more digital and more mobile-friendly. According to a report, India and China accounted for the highest fintech adoption rates. Digital payments and insurtech have seen a significant boost over the past quarter. The unprecedented growth in the financial services sector and in the fintech sector in India is a direct result of our rapidly changing demographics and consumer behavior, underpinned by the need for convenience. Not surprisingly, fintech firms attracted investments of an estimated $2.7 billion in 2020. Fintech valuations remain high as investors are seeing this sector as extremely attractive from a long-term perspective. Some of the companies have even achieved unicorn status and are planning for an IPO. At HDFC, when we realized the magnitude of the COVID-19 crisis, we increased our focus on digitization in an even greater manner. In the housing finance space, we were the first one to lay emphasis on online processing during the lockdown. We focused on an online digital platform for loans and retail deposits. We initiated HDFC Customer Connect for all customer requests and launched virtual offices for customer services. HDFC is using digital and social media marketing tools to reach out to customers. We are continuing to see the trend of digital onboarding, particularly with salaried customers. During the first quarter of the current financial year, 88% of our new loan applications were received through the digital mode. We will continue building on our digital capabilities as we believe that this will be a game changer in the years to come. By leveraging data analytics, fintechs have encouraged collaboration between numerous financial service providers and enabled them to deliver products and services through a common platform. From a housing and real estate perspective, I believe that the emergence of PropTech companies will change the face of real estate in India. Technology will increasingly disrupt the real estate sector. It will change the way people search, buy, rent, or manage properties. In fact, capitalizing on technology will immensely help the real estate sector. For instance, progress of projects can be monitored through digital dashboards with data driving key decisions. Funding for projects based on achieving construction milestones can be better monitored online. This will bring in the much needed transparency and accountability and improve cost efficiencies. But as technology keeps evolving rapidly, there is a need to address the risks as well. Cyber attacks, breaches in data privacy, as well as disruption in technology are some of the risks that organizations need to consider very seriously. Cybersecurity poses enormous business and reputational risk for companies, and the increased prevalence of remote working has made it even more critical for companies to manage cybersecurity risks. The World Economic Forum, in its Global Risk Report of 2021, has stated that cyber attacks are one of the biggest risks that businesses face, and that cybersecurity infrastructure of businesses could be rendered obsolete by sophisticated cyber crimes, resulting in economic disruption. Due to increased instances and data breaches, many companies are regularly discussing cybersecurity as part of the board agenda. The board of directors of a company need to ensure that cybersecurity forms part of the overall risk management practices, and it is not just an IT. As digital technologies such as cloud computing, artificial intelligence, and blockchain continue to advance, their impact on risk assessment needs to be closely monitored. A company's risk management structure should include an ongoing effort to assess and analyze how technological developments may impact the company's profitability and prospects for sustainable long-term value creation. Investors are making it clear that board oversight of cybersecurity risks should be a priority. Additionally, stakeholders want to see how well the board responds to cyber attacks. They want to ensure that preventive measures are being implemented to ensure that customer data remains as secure as possible. Companies need to implement and maintain comprehensive cybersecurity mitigation programs, data testing procedures, and cyber attack response plans. Discussion on cybersecurity needs to get adequate time on the board agenda. Apart from recruiting new members who have cybersecurity expertise, board may also consider hiring external experts to explain the latest technologies and best practices to help directors become more educated on cyber risk and preparedness. Further, as the digital economy is expanding across borders, sharing of international best practices and coordination of standards will be of paramount importance. In conclusion, I do expect our economy to exceed growth projections this year. The macro fundamentals remain strong, consumption trends will sustain, and India will continue to leverage its strength in technology. The stock markets are reflecting optimism, with several IPOs being lined up, and most of the financial sector players are now extremely well capitalized. Over the past decade, India has endured several crises, such as the global financial crisis of 2008-2009, the US tantrum in 2013, and the IL&F in 2018. The trend was that it created an atmosphere of risk aversion, but regulatory measures and the inherent strength of the Indian economy, together with strong support from the government, along with the strong fundamentals in the economy, led to recovery. India has proved to be a very resilient economy. In a post-COVID-19 world, India has already started climbing back up the growth ladder. I remain extremely optimistic about India's growth. The main reason for my optimism is that India is a strong domestic consumption-based economy, and penetration levels are so low in India that the scope to grow remains immense. On the same lines, I have a positive outlook on the financial sector in India. It is closely linked to the economy and is poised to grow significantly due to rising incomes, significant support from the government, and the ever-increasing pace of digital adoption. However, we have barely scratched the surface in terms of reach. The focus on digitization will help in unlocking its true potential by reaching out to millions of people who do not have access to financial services. Fintech should not be seen as a competition for banks, but as a much-needed collaborator with mutual benefit. When this is all over, we will look back and not be able to believe that such a scenario happened. It is often said that India performs best in a crisis. The pandemic may just have been the catalyst to bring in further reforms to ensure India's sustained long-term growth. Thank you very much for having me here today.